As financial institutions navigate the fast-paced and data-driven landscape of modern finance, advanced analytical techniques have become indispensable. These techniques, powered by artificial intelligence, AI, and machine learning, are revolutionizing financial forecasting, risk management, and decision-making. In this chapter, we delve into the cutting-edge methods that financial firms use to enhance their strategies and maintain a competitive edge, covering topics such as predictive analytics, prescriptive analytics, machine learning algorithms, AI-driven financial models, and a case study on algorithmic trading. Predictive analytics for financial forecasting. Predictive analytics is a game-changer in financial forecasting. By leveraging historical data, machine learning, and statistical models, financial institutions can forecast future trends and make more informed decisions. This technique allows firms to anticipate market movements, customer behavior, and potential risks, thereby improving their operational and strategic outcomes. The core of predictive analytics lies in extracting valuable insights from massive datasets. In finance, this data often includes stock prices, transaction histories, economic indicators, and even customer demographics. Analysts use machine learning algorithms to create models that can predict future outcomes based on these historical trends. One of the most popular applications of predictive analytics is in stock price forecasting. Investment firms use predictive models to anticipate price fluctuations by analyzing past market data, economic conditions, and company performance. This enables traders to make more accurate predictions about future stock movements, helping them time their buy and sell decisions to maximize returns. Credit risk assessment is another area where predictive analytics is crucial. Banks and lending institutions use predictive models to evaluate the likelihood of a borrower defaulting on a loan. By analyzing past loan performance, credit scores, and economic data, financial institutions can assign risk scores to borrowers, helping them manage risk more effectively and tailor loan terms based on risk profiles. Moreover, fraud detection relies heavily on predictive analytics. Financial institutions use models to monitor transactions in real time, identifying patterns or anomalies that may indicate fraudulent activity. For instance, if a transaction occurs in an unusual location or significantly deviates from a customer's typical spending behavior, predictive models can flag it for further review, helping to protect both the institution and the customer. However, predictive analytics faces challenges in finance. External factors such as political instability, regulatory changes, or global crises can significantly impact financial markets, making it difficult to rely solely on historical data for predictions. Additionally, the quality of the data used in predictive models directly affects their accuracy, requiring constant refinement and updates. Prescriptive analytics and decision-making. While predictive analytics forecasts future outcomes, prescriptive analytics goes a step further by suggesting actions to optimize those outcomes. This approach combines advanced algorithms, machine learning, and data modeling to analyze potential decisions and recommend the best course of action. In finance, prescriptive analytics is invaluable for investment portfolio optimization. Investment managers can use prescriptive models to evaluate various asset allocation strategies under different market conditions. These models suggest the optimal balance of investments, considering factors like risk tolerance, return expectations, and market volatility, helping investors make informed decisions about their portfolios. Prescriptive analytics is also revolutionizing risk management. Financial institutions face a myriad of risks, from credit and market risks to operational and compliance risks. Prescriptive models help manage these risks by predicting potential scenarios and recommending mitigating strategies. For example, if a model identifies a high likelihood of a borrower defaulting on a loan, it can suggest adjusting loan terms or tightening credit policies to minimize the risk. In customer relationship management, prescriptive analytics enables personalized services. By analyzing customer data, banks can predict future needs and recommend tailored financial products. For example, if data suggests a customer is likely to buy a home soon, the bank can proactively offer mortgage options, enhancing customer satisfaction and engagement. However, implementing prescriptive analytics requires high-quality data, sophisticated models, and seamless integration into decision-making processes. Financial institutions must ensure that these models are not only accurate, but also compliant with ethical standards and regulations, especially when handling sensitive customer data. Machine learning algorithms for data analysis. Machine learning algorithms are at the heart of many advanced data analysis techniques in finance. These algorithms can learn from historical data, make predictions, and adapt to new information without explicit programming. making them invaluable for handling complex financial data sets. One of the primary uses of machine learning in finance is in predictive analytics. Algorithms like linear regression, decision trees, and neural networks can analyze past data to forecast stock prices, interest rates, or economic trends. For example, a neural network might analyze historical stock prices to predict future movements, helping traders make more informed decisions. Credit scoring is another key application of machine learning. By analyzing historical loan data, machine learning models can predict the likelihood of a borrower defaulting on a loan. These models can process vast amounts of data, including unconventional factors like social media behavior or spending patterns, to provide a more comprehensive risk assessment. Machine learning also plays a critical role in fraud detection. Algorithms continuously analyze transaction patterns to identify suspicious activities, such as unusually large withdrawals or purchases made from different geographic locations. Once an anomaly is detected, the system can flag the transaction for further investigation, helping to prevent fraud in real time. Despite the advantages, implementing machine learning in finance comes with challenges. The quality of the data used to train these models is critical. Poor quality data can lead to inaccurate predictions. Additionally, machine learning models can be complex and difficult to interpret, making it hard for financial professionals to understand how decisions are made, especially in highly regulated environments. AI-driven financial models. Artificial intelligence, AI, is reshaping financial modeling by automating complex decision-making processes and improving the accuracy of forecasts. AI-driven financial models can analyze vast datasets, identify patterns, and learn from data over time, offering a dynamic and evolving approach to financial analysis. In quantitative trading, AI-driven models analyze market data in real time, executing trades at lightning speed based on predefined criteria. These models can process far more information than human traders, identifying opportunities based on minute market fluctuations and executing trades with precision. This has given rise to algorithmic trading, where AI systems autonomously trade financial assets, often outperforming human traders in speed and accuracy. Risk management is another area where AI is making a significant impact. AI-driven models can analyze various risk factors, such as credit risk, market volatility, and geopolitical risks, to provide more accurate risk assessments. These models can predict potential financial downturns and suggest mitigation strategies, helping institutions protect themselves against adverse market conditions. AI is also transforming personal financial advisory services. Robo-advisors use AI algorithms to provide personalized investment advice based on a client's financial goals, risk tolerance, and market conditions. These platforms automatically adjust investment portfolios in response to market changes, offering a cost-effective alternative to traditional financial advisors. However, AI-driven models face challenges, including concerns over transparency, the black box problem, and data privacy. Financial institutions must ensure that AI models comply with regulatory standards and are transparent in their decision-making processes. Case study: algorithmic trading. Algorithmic trading has revolutionized the way financial markets operate. This case study explores how Alpha Trading Solutions, a medium-sized trading firm, successfully implemented algorithmic trading to enhance its market position. Alpha Trading Solutions transitioned from manual, human-driven trading strategies to fully automated algorithmic trading. The firm developed algorithms based on historical market data, programmed to execute trades when specific conditions were met, such as price discrepancies or changes in market volatility. Before going live, Alpha Trading rigorously back-tested its algorithms using historical market data. This process allowed the firm to refine its trading strategies and ensure that the algorithms performed optimally under various market conditions. Once satisfied with the back-testing results, Alpha Trading deployed its algorithms in live trading. The results were immediate. The algorithms could process and analyze large volumes of market data in milliseconds, executing trades far faster than human traders. This allowed Alpha Trading to capitalize on fleeting market opportunities, increasing both the volume and profitability of its trades. However, the implementation was not without challenges. The firm had to invest heavily in upgrading its infrastructure to support high-speed data processing and trading. Additionally, there was initial resistance from veteran traders, who were skeptical of relying on algorithms. Over time, with training and gradual integration, the traders embraced the new technology. Alpha Trading's experience illustrates the transformative power of algorithmic trading in the financial markets. By automating trading decisions, the firm was able to increase its efficiency, reduce human error, and enhance profitability. In conclusion, advanced analytical techniques are reshaping the financial sector. Predictive analytics, prescriptive analytics, machine learning, and AI-driven models offer powerful tools for forecasting, decision-making, and risk management. As these technologies evolve, financial institutions that embrace and integrate them into their strategies will be better equipped to navigate the complexities of modern finance and maintain a competitive edge.